Today, I will be spreading some light on the impact of inflation in the stock market. At first, we should have a clear idea what is inflation. Inflation actually is nothing but the increasing of prices. It means suppose there are a basket of goods that goods actually are selected by the authority, and on the basis of those goods the aggregate price level has been increasing over the time. That is called the inflation. Okay, so inflation is there in the in any economy. And why there is inflation? Because inflation mainly happens because of two reasons. One is demand pull reason, and another is cost push reason. So what is the demand pull reason? Demand pull reason is that suppose government inject money government injects money into the economy without considering the production. That is, government is taking the shelter of liberal fiscal policy, and some some projects that is some projects that are helpful for the people, and just merely inject money into the economy. That money does not have any role with production. Actually actually here I should mention one thing. The value of a currency is determined by the demand of the currency and the supply of the currency. Okay, the supply of currency is determined by the monetary authority, and on the other hand, the demand for money, the demand for currency is determined by the production in the economy. So if there is a demand for money that is not coincide with the production, then there is inflation. So so demand pull reason is this. And now the cost push. Suppose, with an example you can understand it very easily. Suppose there are some workers in a factory and they are not happy with the authority, and as a result they have a movement and make a pressure on the authority, and they able to increase their wage rate. And that increased wage rate actually comes from increasing the prices, because the owner of the company will not pay from his own pocket. So they transfer their pressure to the ordinary people, and as a result the price will increase. In another way you can say that the production cost, such as the oil price, has been increasing. And if the oil price is increased, then it has some effect on the production. So production cost will be there, and as a result the price will be increasing, and as a result there is inflation. So these are the basic reasons for inflation. Okay, so this is the inflation. Now, if there is a inflation, what is the impact of it? if there is inflation, it means the value of your currency is is low. Is low. The purchasing power of the currency is low. Okay, if the purchasing power of the currency is low, it means your currency, the value of your currency is low. And so naturally, if the value of your currency is low, then the demand for your currency will be low. And you can find the this situation in the forex market. If in the forex market, if there is a the the currency, actually the value of a currency is determined by the demand for demand for our currency and supply of our currency. And demand for our currency is actually demand for our goods and services. If our country's goods and services are demanded by the foreigners, then naturally they will provide dollar in excess of rupee. So there is a demand for rupee, and that demand will increase the value of our currency. And on the other hand, the supply, that is you can say, the if we are importing more goods, so we have to pay dollar, the foreign currency, and as a result the supply of our own currency will increase in the foreign market, and as a result the supply is more there, and it will pull the value of the money down. So this is the value of a currency in the forex market, and the way through which the value of the currency in the forex market is determined. Okay, so now we have this understanding that how the value of a currency is determined in the economy and in the forex market. So now, if you are a owner of a company and you are producing some goods, and naturally you have to some factors of production from other countries. You have to take some factors of production from other countries, and for that reason you have to buy from other countries all those factors of production, and as a result your cost of production will increase. Okay, because through forex market you are importing, and and as a result your product will not be competitive, and your farm will not gain profit, and so inflation should be should be low, and if but inflation should be moderate. To some extent of inflation should be there for growing the economy. Okay, so this is the situation, and now in recent time the inflation in our country is near about 7.04%, that is in June 2022. At the same time, if you have a look in the USA inflation rate, then you can find that there in that country the inflation rate is 8.54%. Okay, so naturally inflation in India as well as inflation in USA, that is inflation in emerging economy and inflation in the developed economy, has been increasing. And if you compare these inflation rate with the previous years, then you can understand very easily that the inflation rate worldwide has been increasing. And why there is an increasing tendency in the of the interest rate in the in the world? There is also two main reasons. One is the COVID-19, and another is the Russia Ukraine war. And in the COVID-19, the production was stopped, and there is there is only the demand. And at that time, most of the government inject money into the economy following the Keynesian policy, so that to some extent the people can survive. And so this situation you can find in the world. As a result, the supply of money is there, but product in compared with the production, in compared to the production. And so so there is a there is a tendency of inflation. There is a tendency of increasing average prices, and this is the impact of the COVID-19 on the inflation. Now, now, if you look at the Russia and Ukraine war, then you can find that due to this war, the supply chain of production actually actually affected. What is the supply chain? Supply chain means, no country is able to produce a good by using its own resources. So naturally, they have to import some resources or factors of production from other countries, and as a result, the result of the Russia-Ukraine war, there is a break in that supply chain. So if there is a break in the supply chain, naturally the cost of production is high. So as there is an increase in the cost of production, so there is an inflation. So in recent situation, you can understand the why there is inflation. Okay, why there is inflation. Now inflation is not good for any economy, as I have mentioned. So economy, so the authority should have some measure, and that measure should be used for controlling the inflation. And how? There is most important measure, you can say, the tight monetary policy. So if the government, if the central bank of any economy takes shelter of tight monetary policy, then under this tight monetary policy, their motive is to take the money from the economy. Okay, so and this can be done by increasing the interest rate. And you have a news that our central bank, that is RBI, actually increasing has been increasing the repo rate, and the repo rate to control the money supply, and as a result the interest rate has been increasing. Okay, and for specially focusing on the production, the RBI actually increasing the repo rate. Okay, repo rate, that is you can say the interest rate has been increasing. And so what is the situation now? So interest is high. So USA also takes the shelter of the tight monetary policy, and as a result of that, they are trying to take the money back from the economy, and they are issuing new bonds, government bonds, and so 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 the money is, the money, if you are an investor, then you know it, that in the government bond, if you keep your money in the government bond, then it is certain that after some time you will get the return. But in the equity market, the return is uncertain after some time, after after certain time. Okay, so there is a risk. Naturally, there is a risk, and as there is a risk in the equity market, so return, you can have return high in the future. So 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 here is the situation. The the increasing interest rate actually actually take the focus of the investor to the government bond, and and they try to keep their money in a certain position. So so the investors, the financial investors, worldwide financial investors, that is mostly, for example, suppose the investors who are actually utilizing the pension fund, so they try to invest the pension funds in some emerging economy, in some emerging economy, as in the emerging economy, the stock market or equity market, from stock market or equity market, they could earn more return. So so before the high inflation situation, most of the financial investors focusing on the emerging economies, such as in India. In India, they are investing a lot. Okay, but as the USA actually the USA has been increasing the interest rate, or there is an expectation of increasing the interest rate. So people of the investors investing their money in the USA bond. Okay, USA bond, not investing in India. So as a result, they are taking their money from the Indian stock market and investing their money in the USA bond, in USA government bond. So this money is going through the forex market. So in the forex market, demand for foreign currency is high, and supply of our currency is low. So our currency, a value of our currency has been falling. So if our currency, value of our currency has been falling, so exchange rate is very low now. That is near about 77 per dollar. And it is expected by the economists that this rate will be near about 90 per dollar or more. 90 per dollar or more, because the worldwide situation is like that. Okay, so this is the situation of high interest rate. So our stock market has been affected by the inflation rate. Okay, so this is the situation now. So to 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 recover their economy, the USA has been increasing their interest rate, or has been taken shelter of monetary policy, tight monetary policy, India also follow also India also has also followed this same policy. So other countries also follow this. Other countries also follow this because they have to they have to survive. They have to survive. They have to control their economy. Otherwise, their economy will be hampered. So they will also take shelter of the tight monetary policy, and they will increase the rate of interest. They will increase the rate of interest. So what is the situation? Situation is, in the world the rate of interest will be high. Okay, if the rate of interest is high in the world, there is a inverse relationship between the interest rate and the investment. Okay, investment is a, you can say, a very important factor for production. So if interest rate is high, so investment will fall. And as there is a fall in the interest rate, unemployment will be high. So production is low, unemployment is high, the situation, and to some extent inflation is high. The situation is the recession. So in coming times, there is an indication of recession. So, so, so investors who are investing in our stock market should not be afraid of the situation, because in India our stock market is strong. Our stock markets are strong because there are some systematic investment from our citizens, and that money will help our stock markets to survive. So, so not looking at the short run, we should focus for the long run. And in the long run, definitely we have some positive situation, and that will give us more return. Okay, so don't be afraid of the recent situation, looking at the recent situation, and keep your investment running. Thank you. That's all from my side.